Hello, folks. Brandon Chapman with today. It's a Monday video for TheoTRADE. It is April 1st, and this is no joke. Today, S&P finished down slightly. This is the futures, down about 1/3%. But it was Treasury bonds. It was Treasury yields, the 10-year Treasury making a huge move today, up from a close on Friday of about 4.2% to now 4.329% on the TNX here. Bond yields exploding as energy is heating up still, and the inflation data from Friday certainly didn't help, and obviously oil continuing to move higher, and coupled with a lot of unusual option activity trade today in the energy market, showing this thing may continue to have legs. So our topic today is energy option trade explodes as bond yields break out or on the cusp of breaking out. So let's circle back to the S&P 500. I'll just use the SPY here. You'll notice that the Thursday close, long weekend, we had PCE data that was in line, if not slightly above expectations. You can see on the open, we gapped slightly open on the cash market this morning and then began to sell off most of the trading day. And we got a little bit of an upflick action towards the end of the day. Now, as you look at the top performing sectors, really, it was energy early, and you did see the Google trade start to pick up as their promise this time they're going to delete, incognito. It's supposedly they're not keeping it, right? But now they're going to be deleting that as a result of a lawsuit. And that trade began to pick up throughout the day, lifting XLC. But really, it was all day long. It was the energy trade that remained fairly resilient and leading the session for leading the day in terms of sector performance. Real estate, healthcare, staples, industrials kind of bringing up the tail end of this, especially REITs. Now, why would REITs see such decline today? Again, these are interest rate sensitive parts of the market. So when you have yields rise like this, it certainly makes the borrowing costs of real estate more expensive. Real estate's not exactly a non-cyclical part of the market. It is very cyclical, but it is interest rate sensitive. So XLU as a sector only finished down 0.6%, but it was XLRE that finished down more significantly, down 1.75%. Well, what does this mean for the market? For those that maybe saw my video last week, I was relatively bullish on the Treasury market. But that bullishness changed or began to turn specifically on Thursday, as what happened on Thursday, we're hitting the upper end of this declining trend line on TLT, and there was some bearish trade popping up on Thursday. Specifically, it was a June expiration, buying the 90 puts and selling the 85. This downside put spread, I told the members to say on Friday to take profits, and we began to price out what a bearish spread would look like. And today, down 2%, we're back down at support, which means what? TYX, TNX. The Treasury market is back up against resistance. But today was a big enough move. You could call this a breakout in and of itself, even though we are at a resistance level right now in yields or a support level on price. Any follow through from here, we're going to look for a more significant correction in the price. Now, if I draw some lines across the TLT product here, fib retracement levels, you'll see we're currently testing close to 50%, but a breakout here, a test of 90 would be very reasonable. If we look at the tail end of this, the low, the high, then the low, this is the measured move on this descending triangle, and we measure it from about 96.5 down to about 92.5. You get a perspective of about a 4-point move on a break of about 92. That should carry you down to about 88. So we may be looking at the bond market fully retracing here. Now, what would cause that retracement to happen? Certainly inflation would have to be a driver. If inflation's high and all of a sudden the Fed's not going to cut, if that puts those aside, then that would cause treasuries to sell off and get back to this October inflationary level that we saw, where bond prices typically go down as inflation goes up, especially long term. And this is 20 plus years we're talking about here. Now, again, what would cause that to happen? Well, again, if oil prices continue to rise, we're currently 83.91. If you look at RBOB gasoline, this has been a nice uptrend. In fact, if we look at a ratio of RBOB gasoline to oil, And I'm going to bring up what's called a pairs ratio study here. What you'll notice is that this yellow line's been rising, which means what? Especially since December, RBOB gasoline or gasoline prices have been rising more quickly than oil prices. So again, if this is breaking down, maybe oil prices are rising a little bit faster. But what that means is prices at the pump are going to get more expensive, right? If this line continues to rise, and even if it comes down a little bit, if oil prices are rising, we're seeing both of them rise together. And so we have a couple of different pathways for higher gasoline prices specifically. And again, one of those pathways is what? Higher oil prices, right? Even if gasoline prices don't quite keep up, it's still pushing up gasoline and oil prices together. Now, what makes me assume that we're going to have bullish pressure on oil prices? Well, this has been my take since when? Early February back here, as oil began to turn into what's called backwardation. And in fact, that happened specifically or began to turn on February 9th. So I'm going to bring up a February 9th chart here, and I'll show you, I'll add another curve for February 8th. And what you'll see is this transition from 9th to 8th here. So as we kind of zero in down here, notice that actually, I guess on the 8th, this is right here. We're in, that's March 8th. I need February 8th. Where are you? Go back one, February 8th. And so as we look at prices here, what you'll see is that, again, we're seeing that a little bit of a slight backwardation on the 8th. On the 9th, we continue to see that move. So this is when the backwardation began. What backwardation means is that prices here are higher than prices there or there or there. What it means is there's an implied shortage, that the cost to finance and store oil is cheaper than what you can lease it out at. And we're seeing is that shift from where this backwardation began to where we are today, a much steeper line, meaning that the discount or the forward premium, the net cost to carry being positive, is more significant today than it was, for example, in February of this year. And this backwardation is positive on prices. It's implying that there is a shortage, right? There is a shortage, whether it's currently exists now or expected in the future. And certainly you think about all the geopolitical risks that happened over the weekend, attacks in Iran, I mean, all this other stuff swirling. And we see potentially production globally curtailing. You know, we can look here at the U.S., for example. I'm going to bring up CME group here. Oops, the wrong one. The EIA tool here. And we'll just refresh this. And we can see, you know, is production. So if we look at crude oil here, production and supplies is kind of the middle of the range over the last 5 years. It does incorporate COVID, but also notice production's declining here a little bit. We're starting to ramp up production of gasoline, which may cause more demand on oil as far as inventories, and may cause prices to increase there. And we may see this turn down. So seasonally, do we normally see a turn down? Yeah, we kind of do. We see a bit of an uptick here. But again, some of this ties into COVID. So it's not as transparent. But again, right now we're in the middle of the bottom part of the range of crude oil inventories over the last 5 years. And again, the contango market, or rather the backwardation market, suggests more of a bullish outlook for oil prices. And we're feeding off this at the moment. And today there was a number of significant option trades. We had that big bearish trade in TLT on Thursday of last week. But today we're seeing a rather significant amount of bullish option trade on energy stocks, and specifically also in the energy ETF, the sector ETF. So in XLE, let's look out into June. So we're coming out here just a little ways here, just, you know, out. Notice 66,000 contracts traded, mostly bought at the 105 strike. Again, that's what? It's over 10% out of the money. 105 is up here. Is that likely? Well, I've got my retracements on here. We've blown through them at this stage. I have this kind of measured here. Let's draw a more of a current outlook for energy prices. We look at the seed wave that developed here before the consolidation. So if we measure that seed wave starting at the end of the move and going back to the beginning, notice we're at the 261 level, but stretching beyond this point, kind of that extended kind of fifth wave dynamic. 105 is in play, and the energy trade today, significant as it is, at the 105 strike. So we're seeing a lot of buying at the 105, and again, that's around or near the 423% projection based on the seed wave at the outset of this trend. And I've continued to say since February 8th, February 9th, to be long energy, even in my weekly videos like this. And again, it's paid off as this has continued to roll. Now, it wasn't just an XLE, MRO, Marathon Oil. Now, as you look at the Analyze tab here and go to fundamentals, exploration production company, right? Natural gas liquids. This is not a company that is necessarily as diversified or as integrated as like CVX or Exxon. There's an element to this. This generally will perform with those. We've had a huge run here in MRO. And again, if we kind of take this as our seed wave right here, again, what is we have in store? 261, where's 423? It's back at almost 32.5. Break this out to 3 years. We're looking at getting back to prior highs last seen in 2022. All right, well, let's look at the option trade today in MRO. This is for a May expiration. You notice we got weekly options. There's generally pretty good depth in this. And we're looking at the 28 strike right here. The volume is greater than the open interest. We're getting mostly buy side activity, buying those 28s. Now, this is more at the money, but it's indicative of money flow. And we're right now testing the 261% projection at the 61% retracement level. We break out from this. We're looking at getting back to 3250 to 3350, which essentially is the 423% projection or the 2022 highs there. So again, a lot of confluence among those fib levels. Let's look at another one here in Oxy. This is Warren Buffett's favorite, we might say. I previously discussed a trade back here, looking at the target. We've broken through the 261. We're en route to 423 as a projection. But again, if we break out some of these long-term levels, we break through 68, the next stop could very likely be the 75 target level, which goes back to our highs from 2022 again. And we look at right now, this has been one seed wave. We look at it on a weekly chart basis. But again, resistance around 67, 68. If we take that out, we're looking for further upside. Well, today's trade in Oxy, this was a May 67.50. So again, about $1 out of the money. This creates kind of a gamma level. 46 days out means it's a little bit dampened a little bit in terms of its gamma effect. But again, notice that the volatility is rising out here. You could buy a 67.5 and sell a 70. Okay, buy the 24.3, sell the 24.6. It's going to cost you about 87 cents on a 250 wide spread. 70 bucks is right there. You've got 46 days or 45 days to accomplish that. Now you might say, I'm not comfortable entering at this level. Fine, you can wait, right? Wait around, wait for the breakout, wait for the retracement. But again, right now, we're just going based on what we're seeing right now. And in the energy market, you're seeing that that there's a lot of option trade kind of playing out right now at the moment today in this space. And it's based on what? This continued expectation that oil prices are going to rise. And there's a lot of stuff out there that might help keep it up. I mentioned the geopolitical risk. And again, declining production. We look at Schlumberger, which this is more of an oil service stock, would benefit by increased production. Well, if oil prices continue to rise, we start to pull in more production that may help them out. We're looking at a really nice move here over the last few weeks. Again, looking back to the 3-year chart here again, could we get back to 61? Yeah, that's about a 10% move from its present level. Today's trade in Schlumberger, this is an April expiration out here at the 57 strike price. That's almost $2 out of the money. And again, this creates a short-term target of 57. Well, where's that? 57 has you very close to, well, we already kind of broke out above the prior highs here. This has you pretty good en route to that $60 target. And again, as we look at option prices out here, we're slightly rising in that April expiration. You go out to May, again, we're kind of following and then beginning to rise at around the 60 to 62.5 strike. The volatility is not quite as supportive, but if we get towards 62.5, Could you play 46 days out? Buy further out of the money. Again, this is a cheap shot at a big move, 37 cents on a 250 wide spread. So if you're willing to lose that 37 cents en route for a bigger move in energy and playing into this positive slope here, buying the lower vol, selling the higher vol, this is a relatively cheap spread to capitalize on a bigger move to retest prior highs at around 62.50. Man, if you could sell that for $1, that's not a bad deal. And you don't need it to get to 62.50 in order to accomplish that. All right, let's look at another one here, because again, it's been pretty big. RIG. So I looked at RIG a little over a week ago as kind of an area of potential strength within the energy space. I've got some old drawings here. I'm going to clear those out. But if we draw a fib retracement, we're just breaking through the 1/3 retracement of that downtrend en route to what? Well, again, 720 would be 61%. We've been looking at getting back to prior highs. This is an offshore oil service company. But even looking at 720, 750 in this range still provides a decent amount of upside. And today's trade was an April expiration, and it was specifically at the 650 strike level. Again, very cheap options. That's 18 days left. If you're going to buy just a directional call or put, you probably want to go out at least 46 days. That $6 strike's costing you 69 cents. If you could see that double, if we get to $7, that's likely close to a double. Just roll it from 6 to 7. Take profits out and just keep a little more risk on, or double down on the 7s if you want and maintain your risk. And again, if we get back to $8, $8.50, $9, that option could be worth rather a significant amount of money. But just roll every 75 to $1 move in the underlying, and you have a chance to stay ahead of this, take your risk out really quickly, and you could play the upside here towards 9 if we get there. And if things break out, if we go to 7, roll it from the 6 strike to the 7 strike. Again, you're basically risk out en route for another potential $2 move in RIG. So just on the oil and oil front, oil service, et cetera, that periphery, these are areas that are showing a lot of strength, and we're seeing significant option activity today. Coupled with that, we're also getting some movement and some buying activity in UEC. It hasn't happened for a while, an old nuclear power plant's getting reopened. Are we going to see more demand for uranium energy products? So UEC here, CCJ is usually one I focus on in this space. Huge breakout today, but the trade in UEC specifically was on the August $6 strike price. So I heard August. Again, plenty of depth in these markets here. The $6 strike price is in the money at $1.65, but again, the spreads are not super tight. 137 days is a little long. You come out here to May, could you buy? We're currently at $7. Could you buy a 7 and sell an 8 as a spread? That doesn't work out so well. This is one you're probably going to buy like a $7 call option. And then look, again, if you could double that up, roll it from 7 to 8. So if we get a move towards $8, roll it to 8. Brisk out. You can maybe probably have some profits in that case, and you're playing that upside from there. CCJ is another one today that's again breaking out in price. You could look at constructing a spread here like a 47, 49. It's a little bit more amenable to doing that. But buy deep and wide 1-1-2 strike vertical costs you 82 cents on a $2 wide spread. We're basically trading the at the money strike. This will go in the money, break evens at 47.82. And all this takes is maybe retest 50, 51 at the prior highs, and you could take this off as a spread trade and walk away. So again, some decent looking trading opportunities in the energy space, whether it's oil service, integrated names, or in this case, uranium breaking out today as well. Again, the higher oil prices certainly causing a need of other sources of energy. And again, maybe we're starting to buy into it. But again, the bond market is being spooked in part by that. Watch this level. Again, what is the potential dampening effect on the energy trade? It's if we're breaking out here significantly, and that begins to drag the market down as a whole. But again, as this breaks out, it's going to have a much more of an outsized effect on real estate and utilities And if we look at the breakdown today, real estate and utilities are one area to look at for bearish opportunities as a result of higher yields. But eventually, I may start to drag on technology that's basically continuing to consolidate. The NVIDIA trade, maybe staging a bounce. And there's some bullish option activity in Micron today, and specifically AMD as well. And we're kind of looking at maybe some slight movement here. But again, watch yields. If yields continue to break out or break through the resistance, this may cause